So for today's class, we are going to be starting a new topic, which is capital budgeting. All right, we want to start capital budgeting. And under this topic, we intend to cover the introduction to capital budgeting. We are going to discuss the steps involved in capital budgeting decision. Okay, then we are going to talk about the characteristics. Okay, we talk about characteristics of capital budgeting. Then we talk about the methods of project evaluation. Okay. Then after that, we will discuss relevant cash flow. Relevant cash flow. Then we'll talk about impact of inflation. And taxation in capital budgeting. Then finally, we are going to have illustrations. So these are the scope that we are going to achieve under capital budgeting. Today, I'll be very happy if I can take up to a method of project evaluation, which I doubt. I doubt it. So like this particular topic will take up for the next 4 periods, minimum of 4 periods. So, and then the positive side of it is that some of you, in fact, majority of you, you have done capital budgeting previously. However, what you did, for some of you that have done performance management before, what you did under performance management, the capital budgeting under performance management is limited to the scope of what you have under financial management. There are other things that you need to know in capital budgeting. So let's take it one after the other.
Thank you,
What do you
sir.
understand by capital budgeting? Let's talk about capital budgeting. Open to the material at your hand. I will just explain, I'll walk you through what capital budgeting is all about. You know, in an organization, when a company wants to undertake a project, a company wants to execute a project, it's not sufficient for the company to just commit the limited scarce financial resources on undertaking the project. So it is prudent for the company to evaluate or to appraise the project if it is financially viable. Say, for example, a company wants to construct an office building. Maybe the company is operating from a rented building. So the company is now contemplating on establishing or developing its own office building. All right. So the fact that the company has the financial capacity to execute the project is not sufficient, because you can't just commit your money into executing a project without determining whether the project is financially worthwhile or not. All right. That's the essence of what we want to do. So before you commit your money into a project, you must ascertain if the project is worthwhile or is financially viable. That is, if the project is going to create additional value for the business. That is essence of capital budgeting decision. All right. So what do you then understand by capital budgeting? Capital budgeting is also known as investment appraisal, okay, capital expenditure, and the likes. All right. So it involves the process it involves the process by which an organization commits its funds into long-term projects. So when you talk about long-term projects are projects that span over one accounting period. Any project that will last for more than 12 months are called capital budgeting or capital projects. Okay, examples include construction of roads, dams, bridges, office building, or other similar investment opportunity. So any project that will last for more than 1 year to complete are what we call capital budgeting or capital projects. However, it is expected that companies or management of a company will usually commit the limited scarce financial resources into any viable projects, okay, by evaluating the projects, all right, using relevant investment appraisal technique, because the main responsibility of any management is to create value for the business. If the value of the company is increased, certainly the wealth of the owners will also be increased by the same amount. All right. And that's why it is important for an organization to evaluate a project to ensure that the project is financially viable. Because any viable project, for example, using NPV, so once your NPV is positive, it means that the project is financially viable. That means the project is capable of creating value for the company. So if the value of the company increase even by 1 naira, it means that the wealth of the owner will also increase by 1 naira. All right. So that is the introduction to capital budgeting. Let's talk about the steps involved in capital budgeting decision. Yes. Let me hold on from there. I've not I've not heard from you because I was already behind, and that's why I could not even hear you. I've not heard any one of you talking. So I want to believe you can hear me and we are together. Yes, Andrew, I can see you. Femi, Ilozo, Emeka, Esther Babalola, Tolu Fayombo, Grace, Gloria. Please, guys, talk to me. I want to hear your voice so that I'm not.
Sir, can hear you loud and clear.
Good evening, sir. We can hear
I
you
want to
loud
be
and
sure
clear.
that I'm
You are
not on my
welcome,
own.
sir. Good evening, sir.
Thank you. Yes, I
Welcome.
greet every one of
We
you
got
because
your
we are
back,
behind.
sir.
Yes, I could. Thank you. All right then. All right. Thank you very much. Yes, Priscilla. Yeah, we can hear you. Thank you. So I just want to be sure that I'm not on my own. All right. Okay, then let's talk about the procedures involved in capital budgeting decision. You know, the basic procedures involved in capital budgeting decision are about 6 of them. One is identification of viable projects. Two is evaluation of projects. 3 is approval and authorization. And 4 is execution and developing projects. Then step 5, monitoring and controlling. Then step 6 is post-completion investigation. Let's talk about each of them. The first procedure talk about identification of viable projects. How do you identify viable projects? Say, for example, if there is need for a company, like I mentioned the other time, that, okay, a company might have maybe a company that is operating from a rented office is now contemplating in having his own office building. All right. For such, the first thing will be that, okay, the company will need to scan the business environment. Okay. The company will need to scan the business environment to be able to identify which areas do we want to site the office building. All right. Because in any organization, location, your choice location matters a lot. All right, you need to cite your office nearest to your customers, where your majority of your customers are operating from, so that you can easily be accessible. All right. So all you need to do is to scan the business environment to be able to identify any investable opportunity. Of course, there are a lot of activity that we go into doing that. So the bottom line is that within an organization, there are some departments or a department that are responsible. For example, you can have around, depending on the size and the nature of the business, like the marketing department or R&D department or business service unit within an organization may be the one that are responsible to scan the business environment to be able to identify any investable opportunity. All right. So once that is done, the head of that department will need to communicate to the management. First thing first, they are going to have a meeting. Then after meeting, then of course, whatever they've discussed and agreed on in that meeting will need to be documented in practice. So we need to be documented. Now, let's say, for example, it is marketing department that will scan the business environment to identify any investable opportunity. All right. So the marketing director will meet with the management to discuss the outcome of their findings. All right. Oh, okay. We have identified an opportunity somewhere, and I will believe that this is a good location for our business, and it's going to help us to do this, to achieve this, to achieve that, whatever. So of course, the directors involved will want to, even elaborate it more than the way it is, just to ensure to attract the attention of the management, and not only the entire management team. We want to ensure he or she gets the buy-in of the management team. All right. So after that, before, the company cannot just say, because we have identified an investable opportunity somewhere, let's commit our money. No. In that meeting, another department will be engaged. All right. For example, the finance department is the one responsible to appraise the project to be able to ensure that it is financially viable. So there and there in the meeting, it will be agreed that, okay, the finance director and his team should go ahead and evaluate the project, which will take us to the second step. The second step is evaluation of projects. Okay, this is the step where all of you and all of us will have responsibility as a finance person. All right. All the people that will work on the project, for example, the person that will be doing the accountants, the financial analyst, the finance manager, the finance supervisor, the finance director, or the chief financial officer, whoever is within that department, within the finance department, they are the one. This is where you have major responsibility. All right. So the project will need to be evaluated in order to ensure that it is financially viable. Therefore, the finance department will work in conjunction with other departments within the organization, especially the marketing department, to be able to ensure that, okay, all the variables, all the information that will be needed to do the evaluation, because the finance department does not have anything to do. It doesn't have anything going to the market. It is the marketing team that usually go to the market, that relates with the customer on a daily basis. So all the cash flows that will be needed to appraise the projects, it is the finance director cannot get it, of course, directly from the customer. So it's the marketing department that relates with the customer on a regular basis, that will provide all those information. Not only that, there are other departments like the project team and all of that the finance team will also need to work with to get all those information. But the bottom line is that the project will need to be evaluated. using relevant investment appraisal technique. I mean, you can use the net present value depending on the capital budgeting guideline of the organization, because every company has its own policy in relation to capital budgeting decision. And of course, depending on the size of the organization. So the project will need to be evaluated. If it is financially viable, then the finance department, which is the head of that department, the finance director, which is the head of that department, we also need to communicate to the management about his evaluation. Of course, it will be in two forms. The first thing, they need to meet physically in a meeting to explain the report. Then that report will also need to be documented. Okay, so if the evaluation shows that the project is financially viable, certainly management will want to commit its funds. So the recommendation from the finance team or from the finance director is that the project is financially viable, and we believe that we can commit our resources to executing the project. If the project is not financially viable, again, that information will come from the finance director to say that this project is not financially viable, which means that if you commit our resources, we are not going to, it will depress, I mean, it will diminish the shareholders' wealth. So therefore, we advise that we should not undertake the project, all right, because it is not financially viable. So the bottom line is that if it is financially viable, then of course management will be willing to undertake the project. So at this point, because it is financially viable, then we need to move to the next step. The next step is authorization and approval of project. Because it is financially viable, management is willing to spend money on it. Therefore, of course, once there is an approval, all right, once there is management approval, which means that we can begin work. So after that, after management approval, then we now move to development and execution of projects. So it is at this point of developing the projects that you need to mobilize people and equipment to site. Because, of course, before you get to that stage 4, the company would have engaged different kinds of contractor, because based on the capital budgeting guideline within the organization, you need to know, all right, are we doing some kind of a single sourcing, or there will be multiple vendors or multiple contractors that will bid for the contract, so that we'll be able to know which of them qualifies to do the job. All right. So there are different teams. We have capital budgeting team within the organization, depending on the size of the company. All right. A whole lot of activity will go into that. All right. Different criteria to be used for the selection of the contractor that will do the job. But the bottom line is that, of course, after the approval of the project, it is at that point, all right, you would have known know the kind of the contractor that will do the job before you get to this step 4. So you are just waiting for that committee would have recommended, okay, it is company XYZ PSC that we think is capable based on these criteria, and based on that can do the job better. So at that point, you are just waiting for management approval. Once you get the management approval, then you need to mobilize people and equipment to site. So at that point, of course, the execution of the project will begin. Then this is the point that the company will the contractor will go to site and begin work. All right. Then after that, we move to step 5. Step 5 is monitoring and controlling our project. This is a very important step. This is a very important step in project execution. The reason being that when you talk about monitoring, it's not sufficient for the company to just put people are working on sites, all right? And you need, as a responsible organization, you need to protect your image. You need to protect your corporate image. How do you do this? Because you have people working for you on sites. If anything goes wrong on site, the company may be held liable, for any negative thing that happens on site. And at this point, the company will need to ensure that it has its own people, representatives on site, because contractor will always want to follow shortcuts because they want to increase their margin. they would do usually an average contractor, we want to maximize their margin and then looking for shortcuts. If you agree ab initio that you are going to use, let's say, for example, 5 bags of cement for that particular activity. Contractor may quote 5 bags of cement for you. They will go ahead and be using 5. They will be using 3. Then the remaining 2, they know what to do with it. All right. So that is what is, if that's what is common among them. So the company has the responsibility to ensure that the right thing is done, the right quality and quantity of material is used as indicated in the contract agreement, because this, before the work begin, there will be a contract agreement that will bind the company and the contractor together. So every party will have his own responsibility, the responsibility of the company and the responsibility of the contractor. So whatever the contractor said he has quoted in the contract that he's going to do, the company must ensure that they are doing it, and the company must have its own representatives on site to monitor the activities of the contractor. The reason why the company should do that is to ensure that the right quality and quantity of materials are used. All right. So you need to monitor the people and equipment on site. Not only that, it's not just about the people. The contractors has mobilized, there are equipment on site. The company must ensure that those equipment are secured, are well secured. All right. So you need to monitor activities of everyone and also equipment on the site. Then the other part of this procedure is control. You need to control your cost as a company. You need to control your cost. To do this, because you have already budgeted for this, you say maybe, for example, 1 billion naira is the cost of the project. That's the contract price. So this contract price, this 1 billion naira is not something you are just going to give out one-off. It's not a one-off thing. It's not something you are going to do a lump sum of money. Just, okay, that's it. No, it will come in installments depending on the project activity, because it's the project activity that will be driving the cost. If, for example, you are starting from foundation, okay, what are the costs? What are the costs associated with foundation activity? Okay, so after foundation, it may be the raising of blocks, setting of blocks. Okay, what are the costs? So it is the activity that will be driving the cost. So the company will need to monitor the cost, the spend on the project. So you need to monitor the actual spend versus what you have budgeted for, because you don't want to exceed your budget. You don't want to exceed your budget. Therefore, you need to monitor what is going on. Again, this is where you also have responsibility as a finance department. The finance department, the finance director, finance manager, financial analyst, project accountant, whoever is responsible, that going to contribute into this, because all of us as a finance person, we also have responsibility here. So you need to compare what you have budgeted for versus actual spend versus what you forecast or what you have projected to spend within the next 1 year or thereabout. So you must ensure that you don't exceed your budget. If you are going to exceed your budget, then you must be ready to provide justification. Why do you want to exceed? Because this is not about you, because like I said the other time, you work with the project team. So it's not your responsibility to be providing justification that, it's because we have an extension of time, because there is a delay in this, or because you negotiated better, then that's why the price go down. It's not your responsibility as a finance person. It is the responsibility of the project team. However, you don't work in isolation. You must work in conjunction with every other project team, because you need that information. In most cases, you'll be the one that will be defending the number that you are not the one on site, but because you work with the project team, you work with the engineers, you work with the marketing team, so you are getting those information from them. So when you are now presenting to the management, you'll be able to, it's not just about you crunching numbers all the time, just putting in, budget versus, and then when you are in a management meeting, you are discussing the project status, then because you just presenting and allow the project managers and other team members to be talking, you have to talk as well. You, as the finance person, you must talk through the numbers. How do you get information? You must, in fact, when you are analyzing the project, it will look as if you are even the project manager, whereas you are not. It's because you have worked with the project team. Every day you are asking them, what is the status? What are the activities? Because before they spend any money, they have to come to you as a finance person, or maybe as a finance director. They have to come to your department. Oh, this is what we want. You need this money for. You ask them questions so that you'll be able to talk through the numbers. So when those costs are now coming in, when the company is now spending the money, the thing is eating your GL. So you'll be able to talk through, okay, this money we spend it on this. Oh, this is the stage where when we were doing the foundation, this is how much we spent, and this contractor, we have invoiced the contractor, but we are yet to pay. Different kind of, you must be able to talk through the numbers. So the essence of this step 5 is that you must ensure that you don't go above your budget. Because if you go above for your budget, you must explain, you must give justification. If you spend below your budget, why did you spend below your budget? If you spend above your budget, why? It may be that there is an extension of time. It may well be that there's a change in scope. Maybe there's something you want to do in the project before, then you now remove it. If you remove it, your cost will be lower. That's a change in scope. Also, if there's something that you don't have in the scope of the project before, you now include it. Maybe there's a new technological innovation that you want to incorporate. So when you do that, the cost will shoot up, the cost will go up. All right. So you also need to give justification, give and take. Whether you spend below or above your budget at all time, you must explain the reason why. All right. So if there's need for you you need additional funds, then it may well be that is a level within is a higher level within the organization that will do the approval. Of course, every project manager will always want to remain within the budget. They don't want to exceed budget. So you can read more. That's all you need as per monitoring and controlling. The last one is post-project, post-completion investigation or audit. Now, the essence of post-completion audits is to ensure that the objective at which the project is being set up has been achieved. So, of course, during the course of executing the project, there will be lessons learned, all right? There will be experience gained or lessons learned. So there will be mistakes here and there. So those mistakes needs to be documented so that in order to prevent future occurrence. So if you have, it may well be that the project manager that executes the project is no more within the system. All right. So if that is the case, once it has been documented, so you need to go back to where it is recorded and we go through it to ensure that similar mistake is not repeated going forward. So that is essence of post-completion investigation. Of course, project manager will make mistake. Of course, that mistake is supposed to aid organizational learning. All right. You don't scold manager for making mistake. Rather, those mistakes should supposed to be documented. After you have corrected it, then you document it so that going forward, you don't repeat it. You don't repeat that mistake again. Of course, that is intended to aid organizational learning. Not only that, okay, it may also be that there's a defect somewhere in the job done. All right, there may be defect somewhere in the job done. So the company will need to call the contractor to come and fix it. And that's why in practice, that's what we call a retention fee. Retention fee is just a small percentage of the contract price that is retained until a specific future date. All right. So the essence of that is to ensure that we are getting value for our money. Okay, so because if, like I said, there's a defect somewhere, and then maybe you have paid contractor 100% the contract price, there will be no motivation for the contractor to come back to come and fix any defect. It will be dragging. But if there's a retention, say for example 2% of the contract price or 5% of the contract price, of course, which is also documented in the contract agreement. So you can easily call back, you can call the contractor to see, the job done is also please come and redo it because there is a defect. This is the issue. So the contractor will come, they will evaluate the place. Okay, this is what we are going to do on that. So of course they will fix it. All right. So that's one of the reasons for this post completion investigation and audit. So you can just go through that because of time. Then, so that's as per the procedures involved in capital budgeting decisions. All right. So let's move to characteristics of capital budgeting. At this level, yes, examiner can ask you, all these things we are talking about, examiner can ask you, but if you are to be professional level, these are elementary. All right. So let's talk about characteristics of capital budgeting. Now, some of the features of capital budgeting include, one is that capital budgeting involves huge capital outlay, all right? It involves huge capital outlay. Whenever you want to embark on capital budgeting activity, which a significant amount of money will be needed to do that. Even if it's going to be your own owner-occupier building, you want to erect your own building, your own residential house or building, you are going to need a huge sum of money, millions of naira, for example. All right. So let alone, say, for example, a government that wants to construct roads. Roads now in today's price in Nigeria is billions of naira. Even if we want to construct bridges, it's billion, depending on the size of the bridge. And that's why you see Lagos State government have been delaying on the fourth mainland bridge. That project has been going on since the period of Ambode, but because of, I believe, majorly because of funding, that's why it has been delayed up to this point. Of course, last year we heard that, okay, the project will commence anytime soon and all of that, but again, we have not seen the physical, some background work are ongoing, but again, the physical work has not really begun. So that's for that. So anything that has to do with capital budgeting, it involves huge capital outlay. A huge sum of money is needed for that. Then number two, the benefits we accrue over a long period of time. All right. When you start a project, you just be spending money on the project. In fact, the first year, second year, even at times 5 years, you are still spending money. Nothing, you have not benefited anything from the project. You are just spending. But after the project has been completed, the project will start generating revenue. So at that point, the company will now begin to reap the benefit for the foreseeable future, non-stop, until the project is no more. That's only when the company will not benefit. So that's why we are saying that the benefits we accrue over a long period of time, over a long period. All right. So that is for that. Then the next one is that capital budgeting is considered to be very risky. All right. It's considered to be very risky. Risky in the sense that it's not certain that you are going to get your money back. All right. You can invest with the hope that, okay, after the completion of this project, I should be able to earn 20% return on my investment, 30% return on my investment on an annual basis. So it is possible that that return may not come. All right. It may also result to financial losses. All right. As a result of that, you will recall that in 2022 February, okay, you will recall in Lagos State, 2022 February, there is a particular building in Ikoyi. Then it was called Ikoyi Gate. There was a particular high-rise building that collapsed in February 2022 here in Lagos. Lagos State government gave an approval for 15-floor building, high-rise skyscraper, and then the owner of the building increased it in conjunction with some unscrupulous government official. They now increased the floor to 21, from 15 to 21. And then, of course, the building gave in. In fact, I think during that period, according to the news, about 4 or 5 youth corpers, youth corpers were affected with that disaster. All the artisans that are working in the building, like the carpenter, the bricklayer, different kinds of artisans, including the owner of the building, all of them died because you can imagine 21-story building collapsed The building that was under construction collapsed on all of them. In fact, a friend to the owner of the building then lived abroad. He came to Nigeria to do one or two things. He was on his way going back to airport. He just said, okay, let me say hello to my friend at the site where they were talking. The building collapsed on them. So you can imagine that kind of a fate, what will be will surely be. All right. So why did the building collapse? You can see I just mentioned Lagos State government gave an approval for 15 floor, and then they increased it to 21 floor, 21-story building. All right. It's one of the reasons why the building collapsed. It may also be that maybe there's a substandard, maybe they use some standard material somewhere. Who knows? All right. So many things could have resorted to the building collapsing. All right. But that's not the details. But the bottom line is that look at the level of investment for you from the ground floor, the money you are going to spend to get approval for the building, for the construction of the building, the money you are going to spend to begin to develop the project up to 21-story, 21 floors. All right. So you can imagine the level of investment. Where is the investment today? They're all gone. Those investments are gone because where is the building? The building is no more. All right. So that's why we said it is capital budgeting decision, or capital budgeting is considered to be very risky. All right. It's considered to be very risky. Another point is that the capital budgeting involves irreversible decision. All right. It involves irreversible decision, meaning that once you have, there's an agreement between the two parties, the company and the contractor. Once you have committed your resource, once you have agreed that you want to execute the project and it has been expressly signed, certainly you cannot say you are not doing again. If you say you are not doing again, then there must be compensation from one party to another party. If you refuse to pay, if you refuse to compensate the other party, then there will be litigation. When there's litigation, the corporate image of the company may be affected. All right. So, that's usually once you have a contract agreement, there is no going back. So if you say you are not going back, then you must be ready to compensate the other party. Then, of course, those are some of the features that you need to take into consideration as well as the capital budgeting decision is concerned. Then, where we have major work is on the project evaluations, methods of project evaluation. That's where we have the major talk to do. All right. So if that is the case, let's take it one after the other. Yes, let me go back to you before we continue. Okay, we can hear you. All right. So, so far, any question for me before we continue on the project evaluation? Any question? If there's no question, let's move on. All right. So, what are the methods of project evaluation? Basically, there are two methods. One is discounted cash flow method. Then two is non-discounted cash flow method. What do you mean by discounted cash flow method? The discounted cash flow method is a method that takes into consideration the timing of cash flow and the time value of money. All right, I will take it again. The discounted cash flow method is a method that takes into consideration the timing of cash flow and then the time value of money. The time value of money connotes that the value of ₦1 today is worth more than the value of ₦1 tomorrow. Why? Because of inflation, price level changes, or the investor preference to have their benefits now rather than keeping it into the future. What we are saying is that if you have ₦1 today, what you can buy with ₦1 today, that's the value. What you can buy with ₦1 today will not be the same thing as what you can buy with ₦1 tomorrow or in next 1 year. Say, for example, if you have 100,000 naira last year, what you can buy with 100,000 naira in 2024 is not the same thing again in this 2025. the value would have dropped because of inflation. The purchasing power of money would have declined as a result of inflation. So that's why time value of money, Ogbeni, give me my money now. I need it. Don't keep it till tomorrow. Don't keep it next month. Let me have it now so that I can quickly use it to benefit. All right. So that's on one side. Another side, on the flip side, investor may say that, okay, of course, rather than keeping the money into the for too long, okay, pay me now, let me have it. All right, let me have it. So you compare, because of inflation and the investor preference to have their benefit now, that's why time value of money matters a lot in financing. I mean, in finance, time value of money matters a lot. Okay, so that's that. Now, what are the methods of project? What are the techniques under the discounted cash flow method? What are the techniques? So under this, we are going to look at the net present value, okay? We are going to look at internal rate of return. We are going to talk about modified internal rate of return. We are going to talk about project duration, project duration. Then, of course, I've selected this to be a separate topic, a separate heading for discussion. So we are also going to discuss about adjusted present value, okay? Adjusted present value. So these are so of course, the profitability index, we are going to do that, to talk more on that under capital rationing, net terminal value and all of that. Okay, so these are the scope that we are going to discuss as we proceed under discounted cash flow method. Then what about the non-discounted cash flow method? Okay, the non-discounted cash flow method is also known as traditional method of project evaluation. Okay, it's known as traditional method of project evaluation. Is a method that does not consider timing of cash flow and the time value of money. All right, it's a method that does not consider timing of cash flow and then the time value of money. The two techniques under the non-discounted cash flow method include the payback period and then the accounting rate of return. The accounting rate of return. So those are the two techniques under the non-discounted cash flow method. So let's take it one after the other. Let's talk about the net present value. So once we are done with the discounted cash flow method, we now moved to the non-discounted cash flow method. So we are starting with the net present value. Again, I'm happy because of the fact that some of you already have the idea of what capital budgeting is all about. Even if you are coming from foundation or maybe you're an accounting graduate, you are just starting skills level for the first time, you already have the idea of what capital budgeting is all about. However, I want you to assume zero knowledge. See yourself as if you don't know it, all right? So let's start afresh. And that's what I'm taking my time to explain the concept to you. So let's start with the net present value. Okay, what do you mean by net present value? Instead of me to be switching pages, so you can just open to the material where you have NPV. So let's go through it together. So what do you understand by net present value? Okay, what do you understand by net present value? So the net present value represents the difference between the present value of cash inflow and the present value of cash outflow in capital budgeting. Okay, I repeat, net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital budgeting. The NPV is considered to be the overall investment appraisal technique. I repeat, NPV is considered to be the overall investment appraisal technique because it is a technique that is consistent with the shareholders' wealth maximization objective. So only NPV is a technique that is consistent with the shareholders' wealth maximization objective, because it is believed that a positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners. So, and not only that, the NPV is an absolute measure, all right? It's an absolute measure of profitability. Once your NPV is positive, you know that this project is financially viable, all right? So, across the world, NPV is seen to be the overall investment appraisal technique. That is in theory, not in practice. All right. So there are different other techniques that you can use in practice that we well, don't let us go there. Okay, then. So that is the meaning of net present value. I said NPV represents the difference between the present value of cash inflow and the present value of cash outflow in capital investment. Okay. Now, how do you then calculate net present value? The NPV, like I said, will be computed. Either you use formula or you use tabular method. Whichever one you use, you get the same answer, except with a rounding error. All right. So how do you then calculate the NPV? Say, for example, I want to calculate NPV using formula. All right. Let me look for a bigger space. Let me clean this one. Okay, so for example, I want to calculate NPV using formula. I would then say net present, you recall that I said NPV is calculated as the difference, okay? Difference between present value of cash inflow. So I will say present value of cash inflow minus present value of cash outflow. So that will give you NPV. How do you then calculate the present value of cash inflow? So the NPV will be computed to get the present value of cash inflow. So you are going to discount the present value, you are going to discount the cash inflow. Say you have cash inflow for year one, we divide it with the discount factor of year one, 1 plus R raised to power 1 for year one, plus cash flow of year two, divided by discount factor of year two, 1 plus R raised to power 2. So you continue like that until you get to the last one. The final cash flow, of course, this is cash flow of the final year divided by discount factor of the final year. So all of this, when you add it together, it will give you the present value of cash inflow. So once you have the present value of cash inflow, right, then you now less present value of cash outflow. That's CO, cash outflow. PV of cash outflow, which is usually from year 0. All right. So when you do this, of course, you get your NPV. That is using formula. I think let me check if I have it down here so that's let me see. Yes. Oh, okay. I didn't include the formula here. In any case, I just show you now. All right. So that's basically how to estimate the NPV. That's how to calculate NPV. If I want to use tabular method, again, we have done this. You do the same thing under cost of capital. We calculated NPV. When we calculated cost of redeemable debt or redeemable preference share, we calculated internal rate of return. Of course, first of all, calculate NPV before we get the internal rate of return. So it's the same thing here. All right. So when you want to use the tabular method, then of course, let me just show you. So you create a column for year, create a column for description of items, cash flow. After cash flow, then you have discount factor, then you have the present value. So start from year 0, say year 1, year 2, year 3. All right. So in year 0, here you have the initial outlay, then you have the cash flows. All right, you have the cash flows. Then, of course, whatever the amounts, you put it there. In year 0, you put the amount there. Then, to get the present value, you need to discount it. All right, so you put the discount factor here. When you multiply discount factor, cash flow with the discount factor, it will give you the present value. All right, so you add up. To now get your NPV, you need to first of all add up the present value of cash inflow. You add it up, then you now less the present value of cash outflow. This will give you either a positive or negative NPV. So this is the format that we have used previously to calculate the net present value. So after this, we need to talk about the decision rule. On NPV, how do you accept a project? That's the decision rule. Okay? Now, for independent projects, accept if NPV is positive. Okay? If NPV is positive, you accept the project. If NPV is negative, you reject the project. But where NPV is 0, the company can either accept or reject the project depending on other qualitative factors. All right. If you calculate your NPV and you have 0 figure, so the company can choose to accept the project or reject it. However, before the final decision is taken, you may need to consider other qualitative factors. So that is decision rule under independent project. I will explain what is independent project, what is mutually exclusive project. But first thing first, let's complete the decision rule. All right. Now, for mutually exclusive projects, you accept any of the projects with a higher positive NPV. Let's say, for example, you have project A, you also have project B. So you calculate NPV for each of them. Let's say NPV of A is 10, NPV of B is 12. Because B has a higher NPV, then project B is selected over project A. All right, that's mutually exclusive project. So any project that has a higher positive NPV will be selected under mutually exclusive project. So let's talk about what do you understand by independent projects? What is mutually exclusive project? Examiner can ask you, especially at this level. What do you mean by independent projects? Independent projects is a standalone project. Let me see whether you have it so that we know whether I should write it down or it's not here. Okay, it's not here. Let me just put it down. Let me just explain. It takes time. Now, when you talk about independent projects, so independent project is a standalone project that may be accepted or rejected based on its own merits. Okay, that is independent project. All right. So it's a standalone project. Say, for example, you want to execute a project, only one project, you want to execute it. So if that project, for example, gives you a positive NPV, you will accept it. If it's a negative NPV, you reject it. That is what independent project is all about. It's a standalone project that may be accepted or rejected based on its own merit. For example, if the project produces a positive NPV, it will be accepted. But if negative NPV, it will be rejected. So that's the explanation for independent project. Let's talk about mutually exclusive projects. So what do you mean by mutually exclusive projects? Mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. I will repeat it. Mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. For example, If project A and B are mutually exclusive, the acceptance of project A will mean we involve the rejection of project B, or vice versa. That is, if project B is accepted, project A will be rejected, because mutually exclusive projects are projects that cannot be accepted together. Only one of the two will be accepted. All right. So I repeat it. Mutually exclusive projects are competing projects. When you say preclude, it means prevent. All right. We preclude the acceptance of the other. For example, if project A and B are mutually exclusive, the acceptance of project A will mean the rejection of project B and vice versa. That's what mutually exclusive projects are. All right. So now we also need to learn about advantages and disadvantages of NPV. Please, at this level, this is also very important. Every areas of the scope of this topic is examinable at this level. So you don't know where examiner will come out to you. So read about the advantages and disadvantages. They are all very straightforward. All right. It takes into consideration the time value of money. Is an absolute measure of return. Like I mentioned the other times, the absolute measure of profitability. All right. It is based on cash flows, not an accounting profit. All right. It considers the whole life of the project, unlike payback period that ignore ignore other cash flows after payback. All right. It's also a measure of shareholders' wealth maximization. These are some of the advantages. There are more than this. So, but these are some of the advantages of the NPV. Then the disadvantages is that it is difficult to explain to managers, especially those managers that are not familiar, with calculations. So they like those kind of manager, the non-financial manager, they like anything in percentage. So once they see percent, 10%, 20% return on investment, they already know what that one means. But when you talk about 10,000, we have 10,000 NPV. What's the implication of 10,000 Naira NPV? Positive 10,000 NPV. What's the implication? They don't. But once you say return on investment of 10%, you already know that, okay, this is what I will earn. So non-financial manager, they usually find it difficult to understand, all right, to understand NPV. Then the second disadvantages is that, of course, it requires the knowledge of cost of capital concept. You are going to need cost of capital to discount the future cash flows. All right, so you must understand how to determine the cost of capital. Then, of course, it is relatively complex to calculate, unlike the internal rate of return. Okay, so that's some of the disadvantages of NPV. So, and that's basically that on NPV. You already know how to calculate discount factor. We've demonstrated that, excuse me, we've demonstrated that under the cost of capital that we did in our first topic. Then also, you know how to calculate annuity factor. So basically, I'll just repeat it. When you want to calculate your discount factor, when you want to calculate your NPV here, you are multiplying this cash flow with the discount factor. You are multiplying cash flow with the discount factor. So to get the discount factor, it is 1 plus R. The formula is 1 plus R raised to power minus N. R is the cost of capital. It will be given to you. N is the useful life of the project. So you do it for year 1, year 2, year 3, year 4, whatever the useful life of the project. So you do it like that to get your discount factor. Now, to get the annuity factor, this is the formula for calculating annuity factor, which we have used previously. All right. So discount annuity factor, or what we also call a cumulative discount factor, is 1 minus 1 plus R raised to power minus N, all divided by R. Of course, R is the cost of capital, N is the useful life, number of years. All right. So you already know all of this. And it is also possible, you may want to calculate annuity factor to perpetuity, to infinity. So to get annuity factor, for example, you want to calculate discount factor to infinity. Discount factor to infinity is 1 divided by R. Okay, when you want to calculate annuity factor to infinity, it is 1 divided by R. Let's say, for example, the discount rate or cost of capital is 10%, R equal to 10%, and you want to know the annuity factor to infinity. So in this case, the annuity factor to infinity will then be equal to 1 divided by R. So it will be 1 divided by 0.10. So this will give you, I think should be 5. Let me see. 1 divided by 0.1. That's 10 years. Sorry, that's 10. Okay, annuity factor is 10. So it is this 10 they are now going to use to multiply the cash flow. So whenever you want to calculate annuity factor to infinity, it's 1 divided by R. But if you want to calculate present value to infinity, let's say, for example, the cash flow is equal to 100 million naira. The cash flow is equal to, let's say, 100 for simplicity. Cash flow is equal to 100. Then you are not given cost of capital. So the cost of capital given to you, for example, is 20%. Okay, so cost of capital, which is your R equal to let's say 15% for simplicity. Let's say it's 15%, and you want to calculate present value to infinity. Therefore, present value to infinity will be calculated as A divided by R. So this A is equal to your cash flow. Of course, R equal to cost of capital. Okay, so to now get the present value to infinity, it will be A, which is cash flow of 100, divided by cost of capital of 15%, 0.15. So this will give you present value to infinity. All right, so this will then be 100 divided by 0.15. That's 666. That is 667. It will be 667. So present value to infinity, this is how you are going to calculate it. That's how to calculate the present value to infinity. So that's that as per NPV. Let me know if you have any question before we move to internal rate of return. So far, any question for me? Talk to me. If there is none, we'll move to internal rate of return.
Sorry, sir. The 1 divided by
Who is
rate, you said
speaking?
it's for what? It's Priscilla.
Priscilla, okay. Yeah, talk to me.
So the 1 divided by R, what is it for? It's the discounted factor.
Y divided by R. It's not Y. Which one is Y?
One,
Okay, 1.
Sorry, 1, yeah.
Yes, 1 is constant. That half
Okay.
is the cost of capital given.
Okay.
1 is constant. The half is the cost of capital. So just divide 1 by cost of capital. It will give you an annuity factor from year 1 to infinity. Pardon?
Okay, sir.
All right then. So now let's move to internal rate of return. Let's move to internal rate of return. All right. What do you understand by internal rate of return? Okay. The internal rate of return is also known as break-even rate of return, yield to maturity, market discount rates, or break-even rates. All right. It can be called anything. All right. So it is the rate that equates the NPV to 0, or is the rate that equates the NPV of future cash flows to the present value equivalent. All right. So any rate that you use to compute NPV or any rate that you assume to calculate NPV and then produce zero NPV, that rate is your internal rate of return. That's why we are saying that IRR is the rate that equates NPV to zero. So you calculate internal rate of return using trial and error method, all right? Internal rate of return is calculated using trial and error method. Under this, there are three procedures you are supposed to carry out anytime you want to compute internal rate of return. Forget about what we have done under cost of capital, under redeemable debt or redeemable preference share. So leave that one. Let's start afresh. When you want to calculate internal rate of return, there are three procedures. The first procedure is to assume two discount rates that will produce two opposing NPV. Let me see if I have it down here. Okay, let me put it here for you. Steps in calculating internal rate of return. Step 1, you assume two discount rates that will produce two opposing NPV. Assume two discount rates that will produce, okay, that will produce two opposing NPV. That is a positive NPV and a negative NPV. Then step 2, you calculate internal rate of return. Calculate internal rate of return using the IRR formula. This is the IRR formula you have here. Then step 3, you advise whether the project is financially viable. So these are the three procedures you are supposed to carry out anytime you want to calculate internal rate of return under capital budgeting. All right, these are the procedures. All right, so the formula to calculate internal rate of return is this. This is the formula for IRR. Okay, so the A is the lower discount rates. The B is the higher discount rates. All right, so that is that. Then, what are the decision rules under internal rate of return? What are the decision rules? For independent projects, accepts if IRR is greater than the company cost of capital, okay? Accepts if IRR is higher than the company cost of capital, which means that whenever you want to advise on the acceptability of projects under the internal rate of return, you are supposed to compare your calculated internal rate of return with the company's cost of capital. You compare IRR with the company cost of capital. If IRR is greater than the cost of capital, it means that the project is financially viable. But if IRR is lower than the company cost of capital, the project is not financially viable and should not be accepted. But for mutually exclusive projects, accept any project with a higher internal rate of return, provided it is greater than the company cost of capital. Let's say, for example, you have project A, you also have project B. If your calculated IRR for A, say for example, is 20%, your calculated IRR for B is 18%. On the basis of your calculated internal rate of return, you see that project A produce a higher internal rate of return. So which means that project A should be accepted. However, for you to undertake this project A, you have to compare it with the company cost of capital. Let's say, for example, the company cost of capital given to you is 15%. So even though the two projects A and B has an internal rate of return that is greater than the company cost of capital, the two of them are viable. But because they are mutually exclusive, you cannot accept the two projects together. So you need to select anyone with a higher internal rate of return. So in this case, project A will be accepted and project B will be rejected. So that is what you need to do under mutually exclusive project. You accept any project with a higher internal rate of return, provided it is greater than the company cost of capital. All right. So what are the advantages and disadvantages? Again, please go ahead and read it through. Just read about advantages. Like I mentioned, at this level, all these things, all these points, all these concepts, they are they are relevant. Okay, examiner can ask you. So, for example, you may be asked to evaluate the project using calculate internal rate of return, NPV, payback period, accounting rate of return. The number B requirement. What are the advantages of NPV? What are the advantages and disadvantages of NPV or internal rate of return or payback period? You need to know them. All right. You need to know them at this level is important. All right. So you can't just ignore it. So please read through the advantages and disadvantages of internal rate of return. All right. So that's that. Let's talk about areas of conflicts between NPV and then the internal rate of return. Areas of conflicts between NPV and then internal rate of return. Okay, so the next we want to discuss is areas of conflicts between NPV and then internal rate of return. When there are mutually exclusive projects, okay, when there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return because NPV may favor a particular project and then internal rate of return may suggest another project. This is an apparent conflict that needs to be resolved. So, what are the causes of conflicts? How do you resolve the conflicts? Examiner can ask you, all right? What are the causes of conflict between NPV and then internal rate of return? How do you resolve the conflicts? So majorly, there are three key causes of conflicts between NPV and internal rate of return. I'm going to use hypothetical figures to explain this so that you'll be able to understand better. Let me use this small space. Say, for example, we have project A, we also have project B. Let's say, for example, the initial outlay of project A is 500 million. Initial outlay of project B is 800 million, right? So let's say the useful life of project A, the cash flow given for project A in year 1 is 300. Year 2 cash flow is 250. Year 3 cash flow is let's say 200 for simplicity. All right. Then year 4 dash. Year 5 nothing for project A. For project B, cash flow in year 1 is 100 million. In year 2, 180. In year 3, 250. In year 4, 300. In year 5, 350. Okay, so these are the cash flows. 300. Let me write it. 300 and 350. Now, let's say, for example, discount factor at 10%. Okay, for year one, of course, year zero is usually 1. At 10% for year one is 0.909826751 683. Year 5 is 621. So these are these discount factors. Now, let's use this one to explain the areas of conflicts between NPV and the internal rate of return. The first reason for conflict between NPV and internal rate of return is when there is significant difference in the amount of capital outlay. One of the causes of conflict is when there is significant difference in the amount of capital outlay. When you look at the initial outlay of project A is 500 million. Initial outlay of project B is 800 million. Because the two of them are not the same, therefore, this can result to conflict between NPV and then the internal rate of return. The project with a lower initial outlay may be favored over the projects with a higher initial outlay. All right, so as a result, of course, the NPV may say, okay, accept project A, while the internal rate of return may say, okay, accept project B. So once there is significant difference in the amount of capital outlay or initial outlay, then that will result in a conflict. So that's what I try to explain here. Significant difference in the size of cash outlay of various projects under consideration. The second one is difference in the pattern of cash inflow. All right, difference in the pattern of cash inflow. When you look at project A, you will notice that project A has a higher positive cash flow at the earlier part. You will see that in year one, project A generated 300 million, year two, 250. In the final year, a lower cash inflow of 200. When you look at project B has a lower cash inflow at the earlier part. Then at the latter part of project B, the company and the project start generating a higher cash inflow. So when you have this kind of a pattern, of course, the decision of NPV may be conflicting with that of internal rate of return. Why? Because you will notice that usually discount factor for the earlier part of a project is always higher. Like in this case, 0.909 is higher than the discount factor at the latter part, which is 0.621. So which means that any project that has a higher positive positive cash flow in the earlier part may be favored over the other project, because when you multiply, for example, when you multiply 300 million by 0.909, so you are going to have 200 and something million. But when you multiply, like in this case now, 350 multiplied by 0.621, it won't give you this. This one will be lower. So any project that has a higher positive cash flow at the earlier part will be favored over the project with a lower cash inflow. That's what I mean by difference in patterns of cash inflow. Okay, let me see. Yes, problem of difference in the cash flow patterns or timing of the various projects. All right, so that's basically that. Then the third reason for conflict is difference in project sizes. When there's difference in project sizes or initial outlay, useful life of projects, then that may be a conflict between decision of NPV and then the internal rate of return. When you look at these hypothetical figures, you will see that project A has 3 years life. All right, project A has 3 years life. All right, from here to here, that's the project A. Project A has 3 years life, but project B has 5 years life. So with this, you notice that project B has opportunity to generate additional cash flows, but project A is just 3 years. So project B has additional 2 years. So the decision of NPV certainly will be different from the decision of internal rate of return. When you have this kind of project sizes, well, project A has 3 years life, project B has 5 years life. So of course, there will be conflicts between NPV and then the internal rate of return. So that's what you have here in this number C, difference in useful life or uh, project life or project sizes. So that's what you mean by that. Now, how do you then resolve the conflicts? How do you resolve the conflicts between NPV and internal rate of return? Not even between NPV and internal rate of return, between NPV and other techniques. Recall I told you earlier that NPV is considered or is adjudged to be the overall investment appraisal technique in theory. So you need to know that it's in theory. All right. So how do you then resolve the conflicts between NPV and internal rate of return? So when choosing between or when choosing among different mutually exclusive projects, all right, the project with a positive NPV should always be considered. Your decision should always be based on the NPV criterion. Why? Because NPV is a technique that is consistent or that is in consonance with the shareholders' worth maximization objective. I take it again. When choosing between mutually exclusive projects, decision should be based on the net present value criterion. Why? This is because a positive NPV will increase the value of the company and which will invariably maximize the wealth of the owners. So, because NPV technique is a technique that is consistent with the shareholders' wealth maximization objective. All right. So that is basically the reason why you have to choose NPV over internal rate of return, except examiner says otherwise. When you are asked to advise whether the project is financially viable, your decision should be based on NPV. But if examiner wants you to use other technique to advise, it's a different thing. But where examiner is silent and you are just asked to advise whether the project is financially viable, what examiner is trying to tell you is that advise on the basis of NPV, because NPV is a technique that is consistent or that is in consonance, all right, that aligns with the shareholders' worth maximization objective, because NPV criterion is more reliable relative to internal rate of return in ranking mutually exclusive project. Okay, in ranking mutually exclusive project, NPV criterion is more reliable relative to the internal rate of return. So whenever examiner is asking you to explain the areas, to explain the reason why NPV is conflicting with internal rate of return and how to resolve the conflict. So all what I've been saying for the past 5 minutes or thereabouts is what you are supposed to explain. So just master this area, all right? So just master it, and that's what you are going to give to the examiner. Okay. So what else? We can't go to relevant cash flow now. So we need more. There are other things we need to talk about before relevant cash flow will be later on. Okay. Yes, let's see. Let's talk about, we have talked about the net present value. We have also talked about internal rate of return. We talked about areas of conflict between NPV and the internal rate of return. We also talk about how to resolve the conflicts. The next thing we want to discuss is modified internal rate of return. Let's talk about modified internal rate of return. Let me go up there and see what I have there for you, what I've noted before. Okay. Think I wrote it down. Oh, okay. Yeah. So we have discussed NPV. internal rate of return. All these profitability index, all those ones will be later on. All right. So let's talk about modified internal rate of return. Now, let me see if I have it here. I should. Let me see. Modified internal rate of return. Oh, okay. I think I omitted that. I might need to update it, then I will reshare. The modified internal rate of return is not here. So I omitted it. So let me just talk about it. Modified internal rate of return. So like I said, I will update this material, then I will reshare to include modified internal rate of return and then project duration. Okay. Maybe I will have to go back to the syllabus again. I don't know, maybe modified internal rate of return is, I don't know why I did not include it, or maybe it's just an oversight error. So modified internal rate of return, MIRR. So the modified internal rate of return is developed to correct the anomalies associated with the internal rate of return. All right. So when there are unconventional cash flow, all right, when there are unconventional cash flow, the assumption behind NPV is that when you talk about unconventional cash flow, there are cash flow that include both the positive and negative. Say, for example, in year one, okay, for year one, year two, year three, let's say cash flow you have for year one is 5,000. Cash flow of year two is 500 negative. Then cash flow of year three is 1,000. So when you have a mix of positive and negative cash flow, this is what is called unconventional cash flow. So when there are unconventional cash flow, it is not appropriate to evaluate a project using the internal rate of return. All right, it is not appropriate to use internal rate of return as a decision criterion because it will be conflicting with the NPV criterion. Now, under this, the assumption behind NPV is that the cash flow generated by projects can be reinvested at the company cost of capital. All right. Generally, assumption behind NPV is that the cash flow generated by the project can be reinvested at the company cost of capital. What do I mean by cash flow generated? Say, for example, you have year zero. Sorry, you have year zero, year one, year two, year three. For simplicity, these are the cash flow given to you. Let's say this is 1,000. That's the initial outlay. You know, initial outlay will always occur at year zero. So we also have in year one, 500, year two, 800, year three, 400. So these are the cash, all these positive cash flows are the cash flow generated by the project. So the assumption behind the NPV is that the cash flow generated by the project can be reinvested at the company cost of capital. That's the assumption behind NPV. However, the assumption internal rate of return is saying that the cash flow generated by the project can be reinvested at internal rate of return. So because NPV and then internal rate of return are always in conflict with each other, the modified internal rate of return was developed to correct the anomalies associated with the internal rate of return. Because internal rate of return cannot be competing or cannot be conflicting with NPV. NPV is consistent with the shareholders' worth. The primary purpose of any organization is to maximize the wealth of the owners, and that's why NPV is superior relative to other techniques. So if internal rate of return is not conflicting with the superior with a superior technique, then in that case, that means internal rate of return is faulty somehow. And that's why the modified internal rate of return is developed to correct the anomalies associated with the internal rate of return. So the modified internal rate of return will allow a decision maker to specify a discount rate or a reinvestment rate for investment purposes. Now, the modified internal rate of return assume that the cash flow generated by the project can be reinvested at a reinvestment rate or at the company cost of capital, which is consistent with the net present value. All right. So modified internal rate of return was developed to correct any negativity, any anomalies associated with the internal rate of return. So that's the introduction to modified internal rate of return. How do you estimate modified internal rate of return? Basically, there are two methods that can be used to calculate internal rate of return, to calculate the modified internal rate of return. You can use present value method or you use the terminal value method. Whichever one you use, you are supposed to get the same answer. I will explain the two for you. Anyone that is more convenient for you, you choose it going forward. All right, let me see if I ask Chris. Now, let me just stop sharing this and move to so that I can express it in the working note. If I go to the working note, okay, let me just use the working note. Stop sharing this. Where are you? Working notes, okay. So estimating modified internal rate of return. Estimating modified internal rate of return. Okay, how do you calculate modified internal rate of return? Basically, there are two methods of calculating modified internal rate of return. Okay, basically there are two methods of computing or calculating modified internal rate of return, including one, let me see. Present value method or terminal, let's start with terminal value. Terminal value method. 2, present value method. So these are the two methods of calculating modified internal rate of return. I will explain each of them and the formula to use. All right, let's talk about the terminal value method. Okay. Terminal, let me write that. What's wrong with you? Terminal value method. Okay. How do you use terminal value to calculate the modified internal rate of return? This method is used to calculate modified internal rate of return by carrying out the following procedures. All right. Steps. under terminal value. Step 1, calculate terminal value for each positive cash flows. Calculate terminal value for each positive cash flows. I will demonstrate how you are going to get your terminal value. All right. Then step 2, calculate. Okay, calculate present value for negative cash flows. For negative cash flows. Then step 3, calculate or estimate calculates modified internal rate of return using the formula below. Okay, or let me write this so that for under each step you will know what to do. Let me write it. I will come back to this ones later. So I said step 1, calculate terminal value. So how do you then compute your terminal value? So you calculate your terminal value as if you want to calculate NPV. All right, but you don't include your zero. So under terminal value, you are supposed to compound the cash flows. You will recall that we said that the modified internal rate of return is saying that the cash flow generated by the project can be reinvested at the company cost of capital or reinvestment rates. So the intention is that you want to reinvest the cash flow generated. All those positive cash flow, they are cash inflows. So you want to reinvest it at what rates? At the company cost of capital or reinvestment rates. So generally, what you are trying to do under the terminal value is to compound it. So to do this, to calculate your terminal value, you create a column for year. If you like, you can include description of items. So you have the cash flow. After the cash flow, instead of discounting, you are going to compound it. So you are going to have compounding factor. Compounding factor. Then you have the terminal value, TV. So let's say, of course, I will explain everything later on when we have live questions. So this is for year 1, year 2, year 3. So here you have the cash flows. Then let's say the cash flow given to you. Let's use figures. Let's say this is 5,000. This is 3,000. And then this is 4,000. So these are the cash flow generated for the respective years. So to now get your compounding factor, right, you are supposed to multiply 1 plus r raised to power n minus 1. You can call it n minus 1, okay? That will give you the compounding factor. I'm coming back to that, okay? All right. Let me write this. Why are you not straight? Better. Okay. So like I said, when you are calculating your terminal value, it's as if you are calculating NPV. Now pay attention here. This is very important. Now, what we are saying is that what we are saying is that the cash flow generated by the project can be reinvested at the company cost of capital or reinvestment rates. All these 5,000, 3,000, 4,000, you want to reinvest it. So when you do this to get the terminal value, you are supposed to compound it. All right. Instead of you to discount, you are going to compound it. So in this case, this will then be equal to, let's say, for example, the uh, the cost of capital given to you is 10% for simplicity. Let's say the cost of capital given to you is 10%. I would then say 1 plus R, 1 plus 10% will give us 1.1, right? So that's 1.10. Let's say you can see that the useful life of this project is 3 years because you have year 1, 2, and 3. So I would then say raised to power 3 minus 1. Raised to power 3 minus 1. Then for the second year, this will be 1.10 raised to power 3 minus 2. In the third year, it will be 1.10 raised to power 3 minus 3. So to get my terminal value, I would then say 1.1 raised to power 2, whatever I have, okay? 1.1, for example, raised to power 2, because 3 minus 1 is 2, raised to power 2. So this will give me 1.21. So I will then multiply 1.21 by 5,000. That will give me the terminal value for year 1 cash flow, which is 6,050. For the second year, I want to invest this 3,000. I want to invest the 3,000. So it will be equal to 3,000 multiplied by the terminal value for year 2. Okay? So in this case, 3 minus 2 will be equal to 1. So 1.1, I will say 1.10 raised to power 1. That will give us 1.1. Then multiply by 3,000. So this will give us 3,300. Terminal value of this one is 3,300. Then 1.1 raised to power 3 minus 3, which is equal to 0. Anything raised to power 0 is equal to 1. 1 multiplied by 4,000 will give us 4,000. So I will then add up everything together. That means terminal value is 13,300. Now, this is what we are saying. So to get your, sorry, let me adjust this. 13,300. Now, this is what we are saying. This cash flow of year 1 that the project generated of 5,000, you need to ask yourself, how many more years can you reinvest this 5,000 of year 1? Year 1 is already out of it. You cannot do anything again in year 1. But this 5,000, you can invest it for year 2. You can also invest it for year 3. That means 2 more years. And that's why you are seeing 3 minus 1, making 2. The cash flow of year 2 of 3,000, you need to ask yourself, how many more years can you reinvest it? You want to reinvest that 3,000. How many more years can you reinvest it? The year 2 that the cash flow occur is already out of it. So you can only invest it for one more year. That's why you are seeing here, this 3,000 is 3 minus 2, which is 1 year, raised to power 1. The cash flow of year 3, you ask yourself, how many more years can you reinvest it? This cash flow occurred in year 3. There is no other year after year 3. That means it's 0. And that's why 3 minus 3 is equal to 0. So if you don't follow this using this formula, then you can just say what I just told you now. You ask yourself, for the first year cash flow of 5,000, how many more years? You remove the year that the cash flow occur. Then the additional years that you have, you consider. Let's say, for example, you also have year 4 here. All right. Let's say year 4, you have 2,000 cash flow. So this cash flow that I'll call in year 1, how many more years can you reinvest it? Let me call one of you, whether you understand what I'm trying to say. Yes, Ogechi. Ogechi, based on my explanation, I've included 2,000 for year 4. So this 5,000 that I'll call in year one, how many more years can you reinvest it? Okay, talk to me. Okay.
Hello, sir. Please say the question again.
Yes. I've included year 4 based on these hypothetical numbers. And then I now said that I now included year 2,000 naira for year 4 cash flow. So I'm now asking this 5,000 cash flow of year 1 generated in year 1, I want to reinvest it. How many more years can I reinvest it based on my previous explanation on this?
It should be 3 years.
How do you mean?
It's supposed to be 3 years initially, then you added another extra 1 year. And the
Yes.
first year has been invested already. So the
Okay.
reinvestment will be, I don't know, but just
Yeah.
in 3 years.
Yeah, you are correct. It's 3 years. So because the year that the cash flow occur, you remove that first year. So you now count the remaining years that you have outstanding. So that would be the years. This is what we are saying. So this cash flow of year one, okay, you ask yourself how many more years you can invest first year, second year, and third year. 3 more years. All right. So that is as per that. I don't want us to overflog that because we still have other 2 more steps. So whenever you want to calculate terminal value, this is the format to calculate your terminal value. Then step 2, you calculate the present value. Okay, calculate present value of positive cash flows, sorry, of negative cash flows. Negative cash flows. Of course, you already know this. When you are calculating present value, you must include year 0. All right, the same format you normally use to calculate your NPV is what you are going to use to calculate your present value. Only that you are not going to include years. You only include year 0 if you have cash outflow for year 0, that is initial outlay. All right, so it is also possible that you may have negative cash flow in between years. So when that happens, let's say for example in year 4 or year 5, you have negative cash flow. So what that means is that you are going to get present value of cash outflow in year 0. You also get present value of cash outflow in year 5. You add the two of them together, it will give you the total present value. But what we are saying is that if you have negative cash flows, all right, if you have negative cash flow, just go ahead and calculate the present value of the negative cash flow. All right, so that is step 2. Then step 3, you calculate modified internal rate of return. Determine modified internal rate of return. Let me just put modified internal rate of return using the formula below. Using the formula below. All right, so that's step 3. So I will then come here, modified internal rate of return using the terminal value method. So this will be DO divided by DN raised to power 1 over n or minus 1. So DO is the terminal value. All right, DO is the terminal value. Let me put it down. Where DO, let me do it this way. Where DO equal to terminal value okay, DN equal to present value of cash outflow. Okay, what else do I have there? N is equal to useful life. All right, that's it. So this is what you need to do using the terminal value method. I repeat, whenever you want to calculate modified internal rate of return using terminal value, first thing first, you calculate terminal value using this format. All right. Then step 2, you calculate the present value of negative cash flows. Then step 3, you calculate modified internal rate of return using this formula. That's all. That's all you need to do. Now, the second method is to calculate modified internal rate of return using the present value method. Okay, using the present value method, present value method. Okay, modified internal rate of return using present value method will be computed by calculating the present value of cash inflow separate and the present value of cash outflow separate. Then you calculate modified internal rate of return using the appropriate formula. So step 1, under the present value method, step 1 is to calculate present value for all positive cash flows. When you say positive cash flows, it means cash inflow. Positive cash flows. Then step 2, calculate present value for negative cash flows. All right, you may have more than one cash flow that are negative in the question. Then step 3, estimate estimates modified internal rate of return using the formula below. Okay, so this particular formula will be given to you on the day of your exam. It's possible. You know, this is a new FM is a new topic, so it's possible. Under SFM, it's usually given. So it's possible you may be given on the day of your exam. So modified internal rate of return will be computed as the present value of cash inflow divided by present value of cash outflow. This raised to power 1 over n. Let me write that. Raised to power 1 over n multiplied by 1 plus the discount rates, all of this minus 1, everything multiplied by 100%. Okay, so this is the formula for calculating the modified internal rate of return using the present value method. Now, the present value of cash inflow is also known as return phase cash flow. All right, you can also call it return phase cash flow. Present value of cash inflow can also be called the return phase cash flow. You know, when the company is reaping the reward on its investments, that's the return phase. When the project is generating cash inflow, all right, that's the return phase of the project. Then the present value of cash outflow, that return phase is also known as PV of cash inflow. Now, the PV of cash outflow, is also known as the PV of development phase or investment phase. All right, we can call it investment phase. Investment phase, cash flow. Of course, it is called investment phase because that is the period whereby the company is spending money on the project. So you are just you are spending money. So your cash in out, that's cash outflow. When you are spending, that's cash outflow. All right. So is either you call it present value of cash inflow or present value of return phase cash flow, or you call it present value of cash outflow or present value investment phase cash flow. All right. So of course, whichever one, you are still saying the same thing. Okay. So that's basically that. What else? Finally, under modified internal rate of return, let's talk about the decision rule. Decision rule. Okay. For independent projects, for independent projects, accepts if modified internal rate of return is higher than the company's cost of capital. Okay. But if it is lower, then you reject. Number B, for mutually exclusive projects, accept any projects with a higher modified internal rate of return, provided it is greater than the company's cost of capital. So that is the decision rule under modified internal rate of return. That's the decision rule. Okay. So our approach will be that I will explain all the concepts under discounted cash flow method. I will also explain the concepts under the non-discounted cash flow method. Then we now have several illustrations to demonstrate the points, one after the other. But for now, so we are explaining the concept. So far, of course, there are also advantages and disadvantages of modified internal rate of return. So yes, this is where we are going to call it a day. In our next class, we are going to discuss project duration. All right, we discuss project duration. After that, we go to the non-discounted cash flow method. We talk about NP, we talk about payback period, and then the accounting rate of return. Once we are done with all of that, we then move to relevant cash flow. What do you mean by relevant cash flow? How do you identify relevant cash flow in a question? If we still have time on that day, then we move to the impact of inflation in capital budgeting. So whatever the case may be, so at this point, I'm happy that we're able to even cover up to modified internal rate of return today. So in our next class, it will be, of course, we have to progress beyond this. All right. So let me know if you have any question for me before we close the day. All right. Any questions so far? All right. So like I said, I will update your study material to include modified internal rate of return as well as the project duration. Okay, as well as project duration. And that will be that for today. And then for some of you that are yet to get your FM material, I will encourage you to get it on time. It's a material that will help you in no small measure. You will love it. It's a very simplified, comprehensive material. And the good thing about it is that, it's beyond this level. is beyond this level. You use it in your FM. You also use it when you get to professional level. So 2-in-1, it's a good combo, great value for money. I will encourage you to get it on time and start using it because it's a book of about 765 pages. It's a big one, all right? So the earlier, the better for you, all right? So when you need it, just DM me, send me the WhatsApp chat. I will tell you, you tell me your location, how it will be shipped or sent to you. And if you are close to any of our centers in Isolo or VI, you can just approach the center and get your copy there. All right. So yes, somebody is sending message. Is there soft copy? Of course, if you want the ebook, yes, just send me the DM. I will tell you. All you need is to send your Gmail, then it will be shared with you. All right, for the ebook. Okay, so that will be end of today's class. By the grace of God, we are meeting again next weekend when we shall continue from where we stop. All right. So Andrew, send me the WhatsApp chat. I will share everything, the details with you. I can even share the link with you. You'll be able to see it. Let me see. Let me see if I can. Okay, I'm coming. Let me open. Uh, just hold on. Greener SFM. Yeah. Okay. No worries. I will share with you because of time. I will DM you. All right. So let's call it a day. I will meet you next time by the grace of God.